This meeting is being recorded.
So this is the disclaimer. You can go through it. Yes. This presentation has been prepared by Synergy Green Industries Limited solely for informational purpose. This presentation contains statements that constitute forward-looking statements. Such forward-looking statements are not guarantees of future performance, and actual results may differ materially from those projected. By attending or receiving this presentation, you agree to be bound by the foregoing limitations. So today's meeting agenda is the brief introduction of our organization. That would be of 5 minutes, investors presentation that would be of 10 minutes, and Q&A session that would be of 45 minutes. Before we start the call, we have to share the guidelines. The guidelines are all the participants are kept on listen-only mode by the host. All the participants are requested not to record the call. Questions from the participants will be addressed in the Q&A session at the end of the investor presentation by the management. During the Q&A session, when called out by the moderator, we request you to introduce yourself with your name, organization, and the question. Participants having multiple questions can email us on the email ID mentioned in the chat box, and management will make the best possible effort to respond within 7 days. Thank you for your cooperation. Dear participants, welcome to the Q2 for year 2025 earnings call and investor presentation of Synergy Green Industries Limited. As you know, Synergy Green Industries Limited is India's one of the leading state-of-the-art foundries producing SG grey iron, and steel casting for wind turbines, wind gearbox, and general engineering industries in the weight range of 3 to 30 metric tons. Synergy Green has an installed capacity of 30,000 metric ton per annum and is in the process of upgrading to 45,000 metric ton. The company houses best-in-class equipment, IT infrastructure in the process of upgrading and quality testing facilities, and is a top supplier to major wind OEMs as well as leading gearbox players in the world. SGIL is a part of the Shirgaonkar Group, which has diversified business interests over its 80-plus years history spanning across sugar manufacturing, foundries, hospitality, and market research, among others. Today, we are having with us Mr. V. Srinivasa Reddy, Executive Director. Mr. Reddy is a BTech in Mechanical Engineering, MTech in Manufacturing, and Executive MBA from IIM Bangalore. He has over 30 years of experience in manufacturing of large castings. Over his career, he has worked for corporates like L&T, ISGEC, and Simplex in establishing plants and managing businesses before joining Synergy Green from inception. Ms. Shreya Shirgaonkar, Management Executive. Ms. Shirgaonkar has completed her MBA in Finance and has worked with Deloitte as part of their energy and industrial research team for over 3.5 years before joining Synergy in 2023. And Mr. Nilesh Malkar, the company secretary, he has also completed his MBA in Finance from Indira Gandhi National Institute of Open University. He has an overall experience of 10 years before joining years in secretarial matters of our company. Now, Ms. Shreya will be presenting us the highlights for Q2 earnings and take us through the key areas of development in the investor presentation. Over to Shreya ma'am. Shreya ma'am, please. Yes.
Thank you, Rima, for the introduction. I'll be going over. So I'll be going over the key highlights of the Q2 presentation. The first thing I'll cover is the industry overview. Then we'll go on to the company profile and brief, and then finally we'll talk about the business performance. So as we know, climate change is not the future, but it's here with us, and renewables are the way forward for us. And the energy transition to renewables is already underway, and renewables are projected to form a part of about 70% of the overall global electricity generation power source by 2050. Talking about the India and global wind installations. In 2023, India and global wind installations grew by over 50%. In 2024, India has sustained such a growth, and also there is promising growth at a global level in terms of installations. Just a little snippet that Indian installations between April to September 2024 are about 1.47 gigawatts so far. There are a lot of growth drivers that we've highlighted on the slide that are sort of fueling this growth for the Indian as well as global wind installations. Briefly looking over the kind of castings demand at a global level as well as by industry. So Synergy is, in a position to cater to a broader castings market. And if we look at the overall country-wise demand, of course, China is leading with India in the second position. And the total overall castings demand from wind is expected to be 1.5 million metric tons. And it's expected to cross 2.3 million metric tons in the next 5 years. Similarly, not just looking at the wind part of it, but looking at the large castings market, this is estimated to be over 8 million metric tons. So large castings is where we as Synergy are positioned to cater to, and that demand is even higher for us. I'll briefly go over the company profile. As many of you, I'm sure, have already gone through and know that we have state-of-the-art facilities at Synergy, as well as best IT infrastructure and an ABL certified quality testing facilities. Something I'd like to highlight here is that we've also recently acquired the TPG certification, which is a very stringent quality certification for transportation and power generation supply chains. Besides this, we've also acquired our ISO 27001, which is the Information Security Management System certification, as well as the ISO 50001, which is the Energy Management System. So this adds to the basket of standards and quality certificates that we strive to keep maintaining. A glance at our product mix. So 70% of our castings go to, wind components. Another 15% goes to gearbox castings, and the balance goes to non-wind castings, which are spread across mining, plastic injection machines, pumps, as well as other general engineering applications. So this is the overall spread of the products that we are manufacturing. Now, our customers are definitely one of our greatest strengths, and out of the total top 10 global wind OEMs, we have 50% of them in our customer basket, so they're already our customers. Just to call out a few names would be Vestas, Nordex, Siemens Gamesa, GE, Senvion. Besides this, we also have Flender and ZF, which are the leading gearbox manufacturers. And then in the non-wind segment, we have, Terex, Ferromatic, Melachron, and Maitland Willow. These are some of the leaders in their particular segments as well, and they are a part of our customer basket. We're also in the process of onboarding Envision and Nordex. Here's a brief overview of the SWOT analysis that we've done. So, for example, the strengths for our organization are that we've already established products with top global OEMs, like I mentioned. We have the ability to produce large castings up to 30 metric tons now. And we've achieved a revenue growth in 11 out of the last 12 years that we've been operating. A couple of weaknesses that we'd like to highlight, and then also what we're doing to overcome them. So limited capacity as compared to our peers. So right now we have a 30,000 ton per annum capacity. We are in the process of expanding this to 45,000 tons. Currently, 100% of our machining activities are getting outsourced. However, the additional 10,000 tons that we're adding is something that we're planning to take in-house, which will also sort of overcome a part of this. Opportunities for us is definitely the fact that there is a very, very high entry barrier for the kind of business that we're in. So while there is a lot of growth in renewables, there's also high entry barriers. And of course, India is being converted as a manufacturing hub. This offers a lot of growing and stable casting demand. A threat would be that 80% of the business is coming from the wind industry. Of course, we have also made sure to have a diversified product mix with non-wind as well as gearbox customers in our basket and volatile commodity prices. So with this brief and quick industry and company profile, I'll jump into the business performance and go through the summary of unaudited financial results for the first half of the year. Looking at a quarterly performance basis, this has been one of the good quarters for Synergy in our history, and I'll call out why. In the second quarter, which ended 30th September, we've had, if we compare it directly with the corresponding period of the second quarter of FY24, we've had a 23.5% growth in revenue. Similarly, our PBDIT has also grown by 25% to 13.21 crores in this quarter. If we take a look at the PBDIT margins, then the margins comparing directly with the corresponding quarter last year has slightly improved or remained stable. If the margins are compared directly with the previous quarter, we've again performed better, more than around 1.5% higher in that sense. Coming down to the profit before tax, the PBT, this is also an area which we'd like to call out, which we've had a jump of 42.5% over the same quarter last year. And the PBT stands at 6.23 crores at the end of the second quarter. Looking at the results for the entire first half of this year versus the first half of the previous year, the total revenue has gone up by 7.5%. Something to call out over here would be that the PBDIT margins have increased in a higher proportion by 16%, and we stand at 23.73 crores. Similarly, our PBDIT margins have expanded by more than 1%. The PBT for the first half of this year has gone up by 28.5% as compared to the corresponding period of the previous year. So these are some of the figures, quickly that we've just called out from our unaudited financial results. We'll dive deep into these in the next slide, where we're looking at an overview of our financials. On the left-hand side, we've put our revenue streams into 5 different baskets, which is wind domestic, OEM exports, direct exports of castings, gearbox, and then non-wind. Just looking at the broader level figures, like I mentioned in the previous slide, we've had a 7.5% growth in the first half of this year in terms of revenue, excuse me, over the first half of the previous year. Now, looking at the different segments over here, in terms of the OEM exports, direct exports, as well as gearbox, we've performed in line with our expectations and what was called out. So for instance, the OEM exports are stable, whereas the direct exports have more than doubled. Similarly, gearbox has also, revenues from gearbox have also nearly doubled. Now, where is this possible, moderation coming from? And that is from the wind domestic as well as the non-wind segment. And this is because there has been a moderation in demand from a couple of customers in both of these baskets. So that is the reason why there is a slight lag in performance in these 2 specific segments. But the other segments we've sort of recovered or done well to cover this up. The revenue growth for the complete year, we're projecting it at 13%. And the first half I mentioned already. Looking at the overall expectation of the executable order book projection for the entire FY24-25, we're expecting revenue to be at around 370 crores. And for FY25-26, based on the order book projections as well as the schedules that are already available with us, we're expecting around 450 crores in revenues. Looking at the PBDIT over the period, there has been a 16% jump in the first half of this year versus the first half of the previous year. And the PBDIT margins as well have expanded. They've gone up from 13.05% to 14.13%. For the rest of the year, or for the overall FY25, we are expecting around 200 basis points of margin expansion over FY24. So FY24, the margins were around 12.5%. So we're expecting around 200 basis points of expansion over this. Talking about the cost structure and the CapEx plans. So of the overall CapEx that we've planned in the upcoming year, the foundry, we've allocated around 60 crores. This is mainly for the capacity expansion, like we mentioned, from 30,000 to 45,000 tons. Now, in-house machining is something that we're establishing, and to establish this, around 10,000 tons per annum is something that we're targeting as, the first phase. So here we are allocating around 67 crores. And then finally, the captive renewable power, where we're investing in solar project. So in the previous financial year, we've already invested for 2 megawatts. This year, we'll be adding another 8 megawatts, and that will take our total captive solar to 10 megawatts. So here we've allocated around 30 crores. Just to go over the quick project progress as well as timelines. The bank sanction was already received in August 2024. Rights issue, something that was expected to close around September 24. The exercise has been completed and in October 2024. Following the rights issue, we've already initiated the captive solar project, which we spoke about. So that is something that has already been initiated. Brownfield expansion, which was already underway, and the rest of the work is already in progress. Similarly, for in-house machining facility, the work on the land is already underway, and ordering for the rest of the machinery is also in progress. So that is something that is currently an activity ongoing. So we've taken certain initiatives for the environment and economics. For environment and economics in several areas that will not only help us with our ESG goals, but also sort of help us economically achieve some improvements. So first thing is the carbon footprint, that is renewables, like I spoke about. We are aiming to achieve 50% of our production to be from green resources by 2030. Waste management is something that we're working on. So thermal reclamation is something that will improve our sand reclamation from 92 to 98%. We're also establishing various technologically, sort of digital initiatives that will help improve productivity, as well as various initiatives that we're taking for energy optimization. So this is the path ahead, and I think I'll just wrap up the presentation with this slide. We are opening up for Q&A. We received a few questions in advance. So I think what we do is first we'll address those questions, and then we'll open the floor for Q&A from some of you who raised your hands. Okay. So I'll just outline some of the questions that we received in advance. So what was the primary rationale behind changing the FY25 growth rate from 20% to 13%? Now, I think I briefly highlighted this in the presentation, but while the OEM export, direct export, and gearbox growth, those revenues are in line with our projection. There's definitely been some moderation in terms of the demand from our domestic wind and non-wind segments, and this has been slightly higher than our estimates. So during Q1, there were early signs of slowdowns, but typically what happens is Indian companies, the figures in the first quarter do tend to be a little bit muted. So we were expecting them to sort of catch up in the second quarter. And since it hasn't recovered during the second quarter, we've accordingly sort of updated our guidance for that period. I'll also hand it, okay. The second question is, what incremental revenue or margins are anticipated from the new capex at 100% utilization? So with the entire new round of capex in place and at peak utilization levels, we're projecting around 550 to 600 crores in revenues, and EBITDA margins around 18% should be held in possible. What is the capacity utilization for all the plants, and what is the future target? So capacity utilization in the first half of FY24, which is the previous year, was somewhere around 78%. In the current year, it is running at around 86%. So with the favorable schedules as well as market conditions, we are expecting it can go up to more than 90% plus sort of utilization levels, especially considering that we're already running at 86% right now. What is the cost of debt? So the cost of debt should be around 9.5% at the moment. Will the bottom line be affected due to depreciation after the commissioning of the capex? So the top line is expected to grow along with the increase in depreciation. So the depreciation to revenue percentage is likely to remain at the present levels. There should not be much of a impact on the bottom line, because it will be supported by the revenue growth as well. What is the revenue, EBITDA, and PAT guidance for FY26 and FY27? So revenue guidance, I think we've highlighted for FY26 in the presentation. So we're projecting around 20% revenue growth for the next 2 years. The present year EBITDA margins are projected at 14.5%, like we mentioned, which is a 200% basis point increase over the previous year. So with complete deployment of our capex, these margins, we're projecting them to expand by another 250 to 350 basis points over the next 2 years. This is once the capex commissioning takes place and we realize those benefits. So these are some of the questions that we're addressing. Now, I think we'll go to the chat box. We have a few raised hands. So, okay, sure. So I'll also hand it over to Mr. Reddy to address any more questions. I think we'll have to start unmuting some of the participants.
Yeah, you can mute.
Okay.
Put this bill. May I request Mr. Mohit to go ahead with your question? Please unmute yourself and go ahead with your question. Mr. Mohit Jain. मेरे को हाँ सुन.
Hi sir, thank you. Hi Shreya, thanks for the presentation. So my question is with regards to Donald Trump's pledge to halt.
Mr. Mohit, please go ahead.
Can you hear me, sir?
Hello? You are unmuted now.
Hello, can you hear me? Hear me?
Yeah, please go ahead. Sorry.
Hi sir. Hi Shreya, thanks for the presentation. My question is in regards to Donald Trump's pledge to halt, renewable energy projects around the globe, and we have seen stock prices decline, investors not at shares. So, do you see any negative signs from the commentary from these big players, and do you see this causing any harm to our revenue projection going forward?
Historically, if you look at, yes, Donald Trump did not favor this renewable industry, particularly offshore. I have also read an article yesterday and day for yesterday. Mainly because today offshore projects are not economically viable because a lot of money is being spent, but still a lot of money is being pumped into the offshore just because that is the only sector which is going to become baseload and replace the thermal capacity. Actually, that was the idea which industry was doing. Of course, Mr. Donald Trump has got his own way of making the thing, but today's energy is not into the offshore. That is one. The second thing is our business demand is too minuscule to the global demand. Like it's a very insensitive for the drop in demand in either US and all those things, because our capacities are too small compared to the total global demand. So considering this, I don't see any much impact because of the something policies are getting changed in the US market actually, no?
Okay, that's all from me. Thank you.
You're welcome. I request Mr. Nitin Dharmawat to go ahead with your question, please.
Yeah. Can you hear me?
Yes, please. Please go ahead, sir.
Yeah. Thank you for the opportunity. So when this new capacity, will get stabilized, and what is the, capacity utilization that we'll be targeting once this gets stabilized?
See, if you look at how capacity addition happen is, one is procurement of equipments and installing it. This is the first part of it. The second part is mobilizing my team and organizing to take out the production out of it. Third thing is getting the demand from the customer. These are the three things actually. First part is, as far as the business is concerned, we are continuously with all new OEMs like Nordex, Envision, and we are trying to align the capacities for the new expansion actually. That's one thing. To answer your question directly to the timeline, we were expecting to complete by March, but the rights issue got delayed by maybe another 3-4 weeks may get delayed, but we should be able to complete within time. That's the first part actually. No. As far as the stabilization of the production is concerned, since it's a brownfield project, should not take very significant time, more than a quarter or so. So that's the second part. And as far as business is concerned, we are trying to take some additional business in the next financial year, most probably third and fourth quarter actually. We are expecting additional business from the new capacity as well.
Got it. My next question is, see, we were doing, machining work outsourced 100% earlier, and now we are doing some expansion over there of 10,000 TPA in-house. So from, current 100% outsource, so how much saving will it lead to by this in-house work and machining, and what kind of other benefits are there for this, so that we have gone back from 100% outsourced to some part getting in-house?
Okay, I'll answer you this in a slightly broader way. Today we are doing around 80-85% of the components in the machine condition, and 15% like gearbox what it goes, we are not doing machining. That's the first part of it. The second thing is our spend on the machining in our balance sheet at a wind level, if I look at it, is somewhere around 15% of our this thing. But if you do in-house machining, there is going to be a cost. Roughly we're expecting 20% of the cost, means 3% has to go for the optional of the machine, and after taking into account of machining operation generate some scrap, that is another 3%. So the 3% to 3%, 6% is expected to the optional cost of the machine shop. Means 12% of the machining capacity should be a savings for our this thing bottom line actually, or towards the investment I can say actually. Now coming back, since we are adding 10,000 tons of capacity, in fact we are trying to maximize, can we push it to 15,000 tons? We are negotiating with the machinists how best configuration that we can get. So at least that should add us 2 to 3% kind of the margin expansion on the present level of the investments what we are doing actually. And there is a serious thought to increase this capacity from 10, 15, whatever adding, that incremental capacity doesn't require a same amount of capital, because the basic building and the land and everything is already pre-invested actually. So that incremental capacity addition cost may be significantly lower than what we are doing in initial investment. So the overall, the present investment what we are doing should add at least to 2-3% kind of the margin addition to the EBITDA.
So this will be ready by September 2025, right?
Yes, we are negotiating with the machinist. We are trying to pick up some ready machines available. Some of my colleagues are already in China now. That should come maybe in May, June. We are targeting 2 machines, but another 2 machines may spill over September, October, because depending on the controller availability. The chip is the shortage is the thing which we see. But overall, on an average, I think by September we should be in an operational condition.
Got it. Next question is, do you see any impact of slowdown in the overseas market? You briefly talked about it in the domestic one. So do you see any impact of slowdown in overseas market?
As of now, I have not got it because see, our customers, the first priority gives to Indian market actually. When it comes to export, particularly, like I think I spoke earlier also, there is a 25% tariff in US market for the exports from China. Now Trump is talking about increasing that 25% to 60%. Means the delta affinity towards the procurement of Indian casting may go up. Actually, I see this as a favorable for our industry, but he's also talking of imposing another 10% in India. But still, a delta basis, India may become more favorable going forward. Again, these are all the things needs to come as a policy actually. That is one. As far as regarding the slowdown and all, as I mentioned in the beginning, we don't have much impact on our demand because we are very minuscule in the global demand, whatever is the. So any change in the marginal demand in the global thing, it's not going to significantly hurt us actually. The second thing is we are adding a lot of new customers. Means the capacity what we are building, even though it's about 550-600 crores, but the business what we are building is almost, if really they take what they are projecting, it is a 700-800 crores kind of customer base we are trying to build actually.
So you don't see any margin pressures currently in this space?
Yes, there are actually, particularly China, because of this new government coming in US and all, they are reducing their prices. We are expecting some the pricing pressure. But the good part in this current expansion, what we are doing is really, if there is no margin pressure, then margins would have been shoot up over 20-22% plus. So this we have already factored in day one while doing the expansion. These kind of pressures are going to come in. So 3-4% kind of we have kept it with us for the pass on to the market. Still we make it. The second good thing is we are going to do brownfield expansion. We are going to get 1 or 2% on the economic scales contribution. All this factored in, we are targeting at around 18% kind of the EBITDA on the matured level actually.
Got it. And one more question is about the debt for the capex. So how much debt we are raising, and what is the peak debt likely to be?
Say last year our peak debt is around 80 crores, including working capital of 35 crores and 45 crores the long-term loans actually. That also includes my preference share of around 10 crores plus. So the actual absolute bank debt is only 25-26 crores in this organization as on date. But now we are going for a fresh debt for the capex, which is about 95 crores, which we already got sanctioned. But I don't see requirement of utilization of complete 95 crores because my balance sheet is not factored in. My current balance sheet profitability is also good. I may have a cash profit of 30 crores plus in the current balance sheet itself. That money is something I will be using for the current capex. And this expansion is spilling over to second half of the next year itself, or the first half of the up to September. So I will have a further cash accrual during this next 4 quarters actually. So overall considering peak debt, the next year the thing should not exceed 150 crores. And thereafter, it should taper down back to the previous levels of 80 crores, what we are estimating.
Wonderful. My final question is, what are the two risks that you see with respect to the revenue and operating margin guidance that you have provided for next 2 years?
See, we are a very diverse company operating into multiple segments actually, and that is in the wind, domestic export and direct exports and gearbox and non-wind actually. The number one risk what I see is what extent China can put pressure. Means that is the unknown thing actually. Tomorrow if 60% tariff puts onto the Chinese market, how China is going to react? How our market is going to, it is a very difficult thing to predict actually, that's one. But I am also continuously interacting with various agencies across the thing, including from my customers and all those things. What I heard is there are also challenges in China, their labor cost going up and also they are at the bottommost level of the pricing. This is what I came across actually, but we need to see whether that kind of thing, anything comes. But still we have enough headroom to play this game. I don't see the immediately, maybe 18%, maybe 1% here and there, but that kind of risk, I don't see any significant coming something and falling. That is one. The second thing is, of course, the Trump is coming as a positive. Always we used to concern about the commodity action. If anything significantly happens, that is one. But last 6 quarters, I see a very stable commodity environment actually. These are the two things which I can see.
Perfect. Thank you so much.
Any effect is there. It will be for a quarter actually. 1 quarter here and there and go up, but I don't see any long-term thing because we have so many businesses to tap in. So if something like today, even though there is a significant drop in some of the domestic customers and all, still our revenues are on the growth trajectory actually, and we are projecting the growth. So I don't see any that kind of risk.
Perfect. Thank you so much and wishing you best.
Thanks a lot, sir. Thank you. May I ask Mr. Praneeth Bommisetti to go ahead with your question, please?
Yeah. Hello. Thank you for the opportunity. So one thing I was can you hear me?
Yes, please go ahead.
So basically, I was curious because we've never been demand constrained. As a company, we've always had customers. We've always been supply constrained. That's what I've at least recognized with the pattern. So let's expecting a 15% growth rate going forward and like a average revenue per ton at like 1.2 lakhs. So that marginally it's reducing because of that from 1.3 to 1.2, let's say it reduces. We will be out of our capacity by 2026, end of 2026, we'll use 36,000 tons. So how are we planning on keeping up with existing, like further capacity? We need to do further capex cycle before we even complete this. So how are we viewing this, or is this a safe assumption to make?
First thing what we're focusing is to take our revenues by 60-70%, like as Shreya has quoted, the 550-600 kind of revenues that almost business is lined up, everything is in place. Only thing task in our hand is execute the project and enhance, expand our margins from where we are around 13-14% level to take it up to 18%. That's first part, which we should be able to finish this task by end of the next year. Everything should settle down actually. If the market demand is in place, everything, all fundamentals remain same. We have a serious plan to go ahead with one greenfield project actually, no? So that should take us to 100,000 tons kind of capacity. Now you may question, how are you going to fund and all? See, we fairly believe if I do around 550-600 crores kind of top line with 18% kind of margin, I will be somewhere around 100 crores from the end of EBITDA. As Mr. Nitinji says, my big debt is not going to be 150 crores. Thereafter, significantly it is going to taper down because if I don't do further capex, I'm going to reduce my debt very significantly actually, no? So my balance sheet permits to pull out 100 crores in the next 2-3 years. This is, I'm very confident of, you know. Balance, we'll see the funding partially from the debt. If necessary, we can go to the market and we can do this expansion. So I don't see any big threat in establishing capacity and doing it. But first of all, step by step, we have to finish the current expansion and take up the market. We will watch within the next 4 quarters how the market is unfolding, and accordingly we'll decide upon.
So I was more curious about because about the 60 crore plan we have, it's only till 45,000 metric tons, right? So for the 100,000 metric tons, when are we planning on starting with it? Because I'm more curious. I'm not curious about how you'll fund it. I'm more curious when you'll start executing it, because with existing demand, we might reach our capacity utilization of 80%, which we are likely going to do by 26 itself. So we are going to start that 100,000 when? That's what I'm curious about.
See, now today we are in 24-25, 25-26 for sure I will not be doing anything. So if everything goes fine, 26-27 we are planning to initiate with the greenfield process. This is our thought process.
Understood, got it. And one more thing, with the substantial increase in margins, and we'll be generating a lot of cash flow. So what are we planning on doing with the excess cash flow? Are we going to repay debt, or is it going to go further into capex, later capex?
No, that's what. Definitely my idea is to bring down the debt. Like if historically, if you look at, we always, now the last year, our debt equity is somewhere around 1.7. In spite of doing such a peak capex, the current year debt to equity further goes down to 1.54 and all those things. Once my capex cycle is completed, I will be comfortable to below 1:1 debt to equity, maybe 0.5 to 1 kind of the closer the numbers actually, no? Again, when I go for a new greenfield capex level, the debt may shoot back to 1.5. So it's always a push and pull cycle between the debt and capacity and all those things. This will continuously keep on balancing one after the other actually, no?
Got it. And one thing is that in the previous commentary, you indicated the increasing direct exports part of our business to around 25% from around 11%. And we already export about 25% from OEM exports. So are we expect this direct exports to cut into our OEM exports, or is it going to be complementary to the existing 25%?
No, this is existing. See, we are given considering already we got, generally we get the schedules almost 18 months in advance actually. No? Based on that we are given a guidance actually. So we are going to get that the export, the forecast what we are given both on the OEM export as well as the direct export.
So wait, the 25% is supposed to be a combination of both OEM plus direct.
No, the direct export itself is 20% growth.
So we're expecting most of the revenues to be driven by exports and not domestically to be mediocre, right?
No. See, I'm not saying 25% of my revenue. We are saying 25% growth over the previous year actually. Okay. So when you look at my last year revenue, it was I think 11.5-12 crores, which may not somewhere around 28-30 crores. So which may go to 80 crores plus kind of thing, you know. So that is what we are given a growth of the absolute value growth. But if you want to look at absolute numbers, the export revenues may be somewhere around 18% kind of the numbers, 18-20%, something like that. And OEM export will be on the similar lane. So around 35%, 40% business is coming from the global market actually, no?
Got it. So, and curious about the margin profile with the gear and non-wind and wind segment. So, which is more profitable for the company?
So naturally, see, my strength is in the wind because this infrastructure is very big. Gearbox we're doing because we want to be in that industry. At some point of time, we see to create one more vertical on the gearbox wherein we can build another 400-500 crores of revenue. So that's another reason why we are keeping it muted. It's a 10-15%, so that it gives me industry exposure. I am one of the player, so it gives opportunity to overnight to add capacity as you know, when I have surplus cash flow.
Understood. And one last question, because I would like to give others opportunity because people to restrict to 2 or 3 questions, so these are most important. Otherwise, there are a lot of other people who have raised hands. So you can send the question to our email or chat box, and we will definitely come back
to you on this. Okay, thank you. May I ask Mr. Vishal to go ahead with your question, please?
Am I audible?
Yes, please go ahead.
Sir, hi sir. Good evening. It's just a general question. We just want to understand what's the outlook for the windmill turbines or windmill products in India and globally. That's one thing. And the focus of the company to penetrate more into Indian economy with the products.
I think it's a very general. I will put it this way, actually, casting is such an industry. It's one of the three of the basic manufacturing process, actually, casting, forging, and fabrication. These are the only three mechanical industries existence for any manufacturing, actually, So, wind contributes only 1.5% of the global demand. Since we are significantly present in wind, we are doing it. But we are also simultaneously trying to enter the other segments. Like as I mentioned in the earlier, participant asked the question about how we are going to look at and all. We are present significantly into the non-wind segment as well, like apart from gearbox, I'm talking about even mining, plastic injection. Those businesses are also highly scalable. Now, if I try to handle all the business together, it will be difficult to handle. We will not have resources. Today, we need to reach certain decent levels in the wind industry, then go on to the other sectors. There is a good opportunity to, even I see something like green hydrogen or even a lot of other segments in oil and gas. So there is enough business in this. Casting is such a huge ocean, actually,
Okay, and what about the company's focus for the India as compared to the global markets?
As far as the global casting demand is about 110 million, out of which India is doing about 11-12 million. As around 10-11% of the global demand is what India is producing. Again, the total 110 million is not an addressable market for me, out of which only 7-8% is relevant because there are a lot of products which are into non-ferrous and other things which we are not present. The second, there are certain component sizes also we are not present. So if you purely look at our synergies presence into this global thing, maybe 7-8% of 110 million, maybe 8 to 10 million kind of the market is addressable market for synergy.
Okay, thank you.
Okay, thank you. Can I ask Mr. Faisal to unmute and go ahead with your question, please?
Hi, Mr. Reddy.
Yes.
I mean, due to this various tariffs being put on China from almost all quarters, we could actually face some kind of a glut in the machining and CNC markets. Are we planning to do something other than wind also that could result in some kind of diversification for us, or some place where at least we would have a shelter to run to? That's one. And I have always seen that wherever there is a large kind of an opportunity like we have in wind, it always leads to a lot of players coming into the ecosystem. And once you are like 2-3 years, 4 years into the cycle, it kind of then develops into a big, very big oversupply situation also. So have you given any thought to that, and do we have some kind of a counter strategy to that?
Okay. To answer your first question about the diversification, it is always we need to strike a balance between diversification versus focus, actually, because focus brings efficiency, diversification distracts the efficiency, actually, but it brings the stability. Now, we feel we try to balance it in simultaneously both. That's the reason why, even though wind segment business is contributing 70%, we are also keeping our hand on the diversified products like the gearbox or even mining, plastic injection and pumps, actually. If I end up in doing too much of diversification with one plant, I'll have a lot of challenge in competing. My efficiency goes down, actually. That's the reason why we are not taking up. But at the same time, we are keeping our eyes open onto these segments. Once our capacities go up, if you ideally ask me next 10 years down the line how we would like to look at this plant, so maybe one plant may be running for the completely for the non-wind, one for the completely gearbox, maybe 2-3 plants running for the wind. This is the kind of the vision what we have actually, But today we are watching this. As long as we can manage this, I don't see any problem as of today. The managing with the right kind of diversity. In fact, if you compare with my competitors, one who's in India, there are only 2 players. They are 100% wind focused. Many times we ask ourselves, are we too much diversified actually? But of course, whatever the way we choose, because if you look at next 5-7 years down, probably we may be well balanced in the diversification point of view, also focus point of view. It means we are focused as well and equally diversified as well, Then the second part of your question about the ecosystem, the too many players coming into the game and becoming a competitive space and all. One of the biggest strength of this business for Synergy is the high entry barrier. It's not that the other players are not entered. Say I'm in this industry for more than 30 years. Way back in 2000, at least 15 to 20 founders in India tried to enter into the business. All of them burned their fingers and got out of this business actually, Even the other players, one who was operating also, unless you don't have a very good expertise, it's always challenging to survive in this business. So the competition point of view, it's not an easy job to someone to enter overnight and go ahead and compete with us actually. Second thing, if you look at the customer perspective, for them, it's only 3.5% of the spend for their turbine, but the risk level is 100%. That's another reason customers just for 1%, 2% here and then pricing reasons, they don't jump onto the different suppliers overnight actually. It's a long journey. Even someone like global leader like Vestas, to take Synergy on board, he took 3.5-4 years in spite of having such a big experience. In fact, I have expertise in producing almost more than 90% of the turbines, Vestas turbines running in India. I have only done it actually, but still they took, because they say Synergy is a new company. So we are going to evaluate. So this is how the kind of entry barrier exists in this industry actually. So I don't see that kind of a challenge as far as this competition is concerned. The bigger thing is from the China actually, because China is a too big a capacity. But again, there is a lot of affinity from the other OEMs to buy from non-China, or particularly if you look at Western OEMs, definitely they give a priority. Even if I am in a marginal striking distance between the Chinese person, even I have met across the Indian buyers, they are pro-India, this thing, they favor the buying through local chances. It's not that they're trying to favor us, because there are a lot of advantages comes with the local supply chain actually. The first thing is they are insulated from the currency fluctuation for the Indian OEMs to buy casting from India. That's one. The second thing, they're also insulated from any government coming for a tariffs or anything. And at the end of the day, when the volumes of India goes up similar to, if not to equal to China, somewhere closer to that, the economic scales, our cost itself will go down. At the end of the day, simple principle of manufacturing is the economy of scale. So that is where the cost is going to go. Why China is competitive? Apart from commodity, electricity, incentives on, another big factor is the volume economy. So that is where we are also getting aligned actually,
Yeah. Sir, what is the participation that our board of directors are having, particularly with regard to the personnel that you appoint at various positions in your organization, and also as to how you are allocating capital, particularly the capital which is going towards the future growth. So is the board raising relevant questions to you? And I would like to really be a fly on the wall and try to understand what goes on in your board meetings.
Yeah.
Even though it's a small company, but
I know. This is not
which is a discipline actually.
Yeah, I understand. This is not a one-man show organization. It's a very professional organization with board of directors, very experienced independent directors from outside. One who was ex-chairman of a big bank. So we have a very strong board actually. Simply whatever I tell, nobody's going to listen actually, unless I give it the justification and all those things. That's one. And at the end of the day, see, we are having 70% stake in this organization. One wrong mistake can take the organization anywhere. So it undergoes through rigorous process, any proposal we do. Even when I took an initiative for the raising the funds to rights issue, it went through rigorous discussion for 6 months. The first thing is, why should we have to
I very well understand that everything is a rigorous discussion, but I would like to know what, at least 3 or 4 questions that were raised, and what was the specific to and fro debates that went on. I'm not questioning the rigorousness of the board.
See, like the way you are asking, they ask the similar questions actually. If I invest, what are the risks from China? If this customer buying, what is going to happen? These kind of questions they ask. Or if you don't achieve what is the projected the margin expansion level, how you are going to do? Or if global market, if something happens. So these are the risk factor questions related to, they will definitely, they keep asking me actually,
And about personnel, are there questions as to whom you are appointing, why you are appointing? And
appointment means we are talking about the organizational appointment.
Organizational appointments, yes.
Organizational appointment, actually, myself and our MD, Sajjan Srivastava, we both of us have the freedom on the company, actually, So they don't get involved into the board doesn't get involved into the operational point of view. So we together collectively discuss and make the decision in the best interest of the organization.
Yeah, I appreciate you answering my questions so well, sir. Thank you.
Thank you. Yeah. Anyone else? Or the previous participant, he was wanted to ask some more question. You can go ahead, please, because now we have another 9 minutes time with us. Can you raise your hands, please? Yeah. Yeah, Mr. Praneeth.
So yeah, thanks for the opportunity again. So basically, I was curious about the overall pricing mechanism. I understand it's based on market forces. But the thing is, like overall, what happened is most of the international OEMs got into lower priced contracts per megawatt during 2020-21 phase. Now, slowly they're increasing the average pricing per megawatt. So despite the policy changes and all of that, for them, the profitability metrics are increasing. So is that profitability metric, incremental profit they're generating, can also translate to us? Because you told it's only 2 to 3%. So can we also increase our pricing a little bit because they can afford to pay us more? So how is it going to be?
See, we are not banking upon increasing the customer price and increase our business actually, because that is not a sustainable model. Not only for the wind industry, any of the manufacturing, this kind of model doesn't work actually, because you need to look at the total global forces. Where do you stand and where is your competition level? Particularly when I speak with respect to China. If you corner someone, customer, ask for a price, you may get it, but that will not be long-term sustainable business model. At the end of the day, everyone should be a winner in this game. Like what we are doing now, we are doing a capex. My margins were around 12%. Now I am trying to push it to 18-20% kind of thing. And I am also able to pass on something to the customer. So what else you want? Means this is a kind of the win-win situation. If I go to say unreasonably margins up to 30%, 25% kind of thing, those businesses are not going to sustain. Then you are giving entry to the new entrant to easy entry. Someone want to do a business with a big capital at a 12%, 15% capital. Still, it is a good for the manufacturing industry. Then once you allow someone else to enter, you are out of the game. So you should always play a game so that it becomes very difficult for the entry barrier, and also you have a very decent margin. I believe 18 to 20% kind of EBITDA margins in a manufacturing industry is reasonably decent. If you take the one best of the even in Indian companies, engineering companies, it's one of the benchmark number actually,
Yeah, I have no doubt that's one of the best we can do, because in manufacturing, getting about 12% is a feat unto itself, usually in especially castings. So raising it above is a great feat. I understand. I was just curious about the pricing, because if they're increasing the price so much, how does it affect us? I understand the overall part of it. So in terms of capex,
I would like to interrupt, Mr. Praneeth. I think, see, they are increasing the prices. It's not to increase their profit. If you really look at the global OEMs, barring few, if you understand how the profitability works, profitability doesn't come only from the price actually, The volume is the bigger player. Even if I get a much better price, if my volumes are low, I end up in losing the game actually, So it's a combination of volume, price and your input prices. These are the three things. Now coming back to as far as the increase in turbine prices are concerned, the global OEMs have increased. Because earlier, this kind of commodity volatility was non-existent. Even I have seen last 25, 30 years, the commodities goes by 15, 20% and it retraces by 10%. But this time around, due to COVID, then followed by Russia, Ukraine war and all, unidirectionally for 6-8 quarters, it is almost doubled. Now, these OEMs are sitting with huge order backlog. They did not have any clue what to do with those orders actually, That is where they stopped executing, slowed down the execution. They went back to the market. They're trying to correct the prices to compensate on the commodity prices. Now, if somebody want to unidirectionally increase the price by any OEM, there are a lot of competition sitting over there. You lose the market share actually. It's a trade-off between your price versus your market share actually. Given the choice, it's always good to have a better market share and a good strike of the price balance actually. This is how the industry happens. This is the same thing is applicable for our casting industry as well.
Understood. Thank you for your detailed explanation. I have one last question regarding the capex. So from 45,000 to 100,000, what could be the incremental capex we might need to put?
See, the foundry can be maybe around 250, 300 crores kind of thing. And the machining will be maybe another 150 crores kind of thing. Means 400, 500 crores is what roughly we're estimating. Again, we need to see because in that 30-40% of the imported component, how the currency is going to play out in 26, what we're talking about, the dollar or anything. So this is the rough indicative number just to spell out actually.
So got it. And in terms of margins also, we are already on the track to go to 18% very easily without much different changes, without basic plans. Can we push it beyond that also? Like, how is it going to go?
Actually, this is a low risk activity as far as margin expansion is concerned, because I need not go to the customer to ask for a price to increase my margins. I'm only trying to reorganize myself, whatever I am spending on the machining and the energy through this renewable solar, we're trying to tap into our bottom line. Like as I mentioned, there is a opportunity. Okay, to elaborate this question, it doesn't give me comfort if someone is more competitive than me. This is a simple answer I will tell you. Today, China is 25% cheaper than me. Okay, but when those castings comes to India, 12% goes in the logistic cost, another 8% is the basic customer. Still, there is a 4-5% gap between me and China. So that I want to knock out. I don't want to buy someone because of some favorism and all, because that demand will not be much. If you want to have a good sustainable demand, it should be competitive. So I believe 18-20% margin, and still I will be very competitive. This is how we are targeting to position ourselves. And second thing is, when I get into the shop floor now, I see so many opportunities still we are not tapped. Something like digitization, automation, process improvement. Getting 1% from the shop floor is quite cheap rather than going and pushing the customer about that another 1% actually. So I am always a man from the shop floor. Means I go to the shop and get something from there actually. There are so many improvement opportunities down the line actually.
Yeah, I understood about the pricing with the customer. That's why I was curious, because you always, in most of the forums, you also spoke about coming to the shop floor and increasing it by 1%, which is very easy. In most of your previous forums also, you mentioned that. So in terms of that narrative only, I was asking, like, you told 18% is now very easily possible. So can that be stretched to 22% with internal itself? So that was my basic.
To answer your question, I have already mentioned in other questions, previous participants' question as well. Actually, if I don't pass on anything to the customer, I stay as it is, it go to 22 to 24%. But I doubt that will stay there. The reason is I need to pass on to them. I am already having a pressure from the market and I need to pass on, because if I have to increase my capacity utilization from today and I have to add more capacity and all, I need to be more competitive. So I am telling you the number after factoring in all the market forces. This is what is the sustainable thing, what I am trying to indicate you.
Got it. So if you're already passing on the productivities, so we've always had this 3 to 4% gap rate. Is that reducing? That means from China, we always had like a 3 to 5% gap between. So if you're passing on the productivity, that means it's reducing further. So how much has that reduced overall?
Actually, as far as this price is concerned, if to answer my question, if you compare me yesterday prices, I'll be at par with China after doing this task. This is the first thing. But I can't underestimate the other side person actually, whether his price is bottom, means what he is going to do, I don't know actually, right? So we are only trying to strike a balance. Our interest should be to safeguard our projected margin, which we'll be happy. The second is maintain a growth and utilize our capacity. This is how I look at, rather than looking at how can I push for another 1 or 2% margin, or how can I get this. So I look at it at my business point of view rather than looking at what is going to happen on the other side actually.
Got it. Thank you so much for your time for explaining it so detailed.
Anyone else? I think 4:58. So yeah, I can take last 1 or 2 questions. If you don't have any questions, then I'll go ahead with the conclusion. No more questions? Okay. Thanks a lot. I'll hand over back to Rima.
Thank you, Reddy sir and Shreya ma'am, for answering the questions. On behalf of entire Synergy Green management team, I would like to thank all the investors and analyst community for joining us today. Happy investing. Thank you once again.